Hi, guys. Welcome to the How I Raise a Podcast, the show where we get an inside, unfiltered look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with David Zhou, Head of Investor Relations at Alchemist. Alchemist is a San Francisco-based venture fund and accelerator focused on enterprise startups. In this episode, we go deep on raising capital for a venture fund, including how to find LPs and build relationships, the most important elements in your pitch deck, tips for engaging with family offices, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out foundersuite.com if you're a startup, or fundingstack.com if you are a VC or advisor, to get an awesome collection of tools for raising capital. It includes a massive investor database, a CRM to manage your raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with David.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by FounderSuite and fundingstack.com. Today I have David Zhou of Alchemist Accelerator. He's the head of IR over there, based in the Bay Area. How's your day going?
It's going great.
All right, we've got a lot to cover, so I'm going to jump right into it. Maybe just first of all, tell us what you do at Alchemist. What's it mean to be head of IR there?
Yeah, so head of IR. So for those who are not familiar with the acronym of IR, Investor Relations, that means I am managing our existing limited partner relationships. And so, as you might imagine, founders need to fundraise, and they go through these pre-seed, seed, whatever, so on rounds. VC funds also need to fundraise because we use money often that is not ours outside of the GP commit. Happy to get into that if that makes sense. But because we have to raise capital, I'm the person for Alchemist. And not only that, managing our existing relationships with our investors, mostly from the limited partner side of things. So that's my role here at Alchemist.
Alchemist is an accelerator, for anyone who's not familiar, focused on B2B, I believe.
We've been around since 2012. We love being first checks. And in terms of being first checks, like we were first checks into LaunchDarkly, Privacera, MoEngage, a bunch of these awesome B2B companies. We are B2B enterprise focused in terms of that. And we are, I think as of recording this, we are on cohort 37 and about 20 companies per cohort. And if people want to do the math, I'll let people do that, but I won't suggest anything else.
Very cool. Well, I've heard of Alchemist, and we've had a bunch of customers on our FounderSuite platform over the years, so it's got a great reputation. So congrats. I want to focus most of this talk on, tips, tactics, et cetera, for raising capital for a fund. So maybe let's start with what's the market like these days? You're out there talking to LPs. You've got your own podcast, Supercluster, which we'll come back to, but what do you think the market is right now for raising a fund?
Market's tough across the board. For established managers, emerging managers, founders, it's tough across the board. It's like this trickle-down effect, right? If everyone's struggling to fundraise from up and down the food chain, like it impacts founders as well. So generally, like imagine your fundraising process, no matter what you're fundraising for, to take twice as long, and sometimes you're raising half as much. We've seen some examples out in the the markets already where you see I don't know if I should mention certain names, but if you just Google like TechCrunch and all that kind of stuff, you'll find some of these names that have raised like half the size of the fund that they intended to. There's a lot of like growth funds being slashed as well. I do fact check me on the numbers, but the last I checked in terms of late 2023, like Series Ds have been slashed by like 70-80%. Series Cs have been slashed by like 65+%. And so everything's down. So there's a lot of struggle to fundraise for like mid-stage growth stage funds as well. And so a lot of people have moved earlier to the point where they'll invest in safes and all the other stuff. But that also means we can be a bit more price sensitive at the earlier stages. Alchemist has always been very price sensitive from the very beginning, but it also means we get to back wonderful founders from the earliest stages. So it's tough across the board. And I've talked with multiple fund managers, GPs, and VCs about their fundraising process. Actually, I was at a dinner yesterday, and this guy, very successful in his own right, was a spin out from a larger VC fund, and he was like, "Holy cow! Like, Fund One was super easy to raise. Like, he raised Fund One in like 2020 and 2021. Fund Two, all conversations are taking 2 times, 3 times as long, and it's still progressing, and it's actually moving in the right direction. But a lot of LPs, limited partners, are doing better diligence, which is a good sign of the market correcting. They're asking all the right questions, and these are all things they should be figuring out to build a 10, 20, 30-year long relationship with fund managers.
Yeah, interesting. We're recording this first day of March, so pretty early in 2024. Do you see things, look into your crystal ball, do you see things still kind of being pretty rough for the rest of the year? Do you think we're at the bottom, starting to see some signs of a rebound, like any kind of early signals or even just prognostications you could make?
So I always shy away from making predictions in general because I wish I had a crystal ball. But I will say from what I've been seeing so far, a lot of folks are waiting on interest rates. I think that is the main interest rates in public markets, and they're not mutually exclusive, right? And once we start seeing interest rates go down, as well as the public markets open back up, because we had a couple like 2, 3 tech IPOs like last year, very, very little. Actually, not 2, 3, but like 2, 3 main ones that have IPO'd last year, and they've just been horribly kind of like slashed in the public markets as well. And that the average kind of like enterprise company is trading like less than 5x on revenue, right? And consumer companies are a little better. That said, there's a lot of hesitation for going public, and why that impacts everyone else is because then investors hesitate. It's like there is no exit market. Like, investors make money when there's an exit because they can't liquidate on year 2, year 3, and all that kind of stuff, unless they're secondaries. That said, secondaries is another market that is doing very well. From many of my conversations with my friends, if you're into the secondaries, either like startup secondaries and or fund secondaries, you can probably buy things on like 60% discount without even negotiating on that, which is insane to even think about. That said, as we start seeing the public markets open back up and the IPOs trade on better revenue multiples, we're going to start seeing more early stage. And why that matters, and it's important to realize that for investors, the market we're investing into is not the market we're exiting into. But why that matters to investors is that then the IPO markets or the exit markets then free up liquidity from limited partners, because so much of their kind of like portfolio is locked up in illiquid assets. Once they have more liquidity, then they'll have the capital to invest in VCs, private equity buyouts, that kind of stuff. And that will allow VCs to then invest more into founders. Timeline wise, I've heard everywhere from we are midway through, meaning we're probably another 2, 3 years out, to early 2025 is going to look better. But in that range of, just imagine, hold the fort for at least till 2025, but conservatively do bet on a 2026, 2027 kind of recovery of the market.
If you were, play a little scenario game here, if you were leaving Alchemist and had the great thesis for a new spin out fund, or your own fund, let's just call it that, let's keep it simple, would you go out now and start to build relationships now, kind of betting on a turnaround in 2025, 2026, or would you wait? Like, you know what I mean? Like, let's just take that real simple example. You've got a great idea for a new fund and you want to do this. What would your timing look like?
So actually, there's a piece of advice one of my mentors gave me many, many years ago, probably 5, 6 years ago or something, definitely before the pandemic. And I was like, hey, if I ever want to raise a fund, like when's a good time to raise a fund? Like how do I time the market? Because every time she's raised the fund, it seemed like she just knew when to fundraise for the market, and she was able to close. I'm not saying this is like the norm now, but at one point in time, in some years ago, this was the norm. But she was able to fundraise for her fund like 9 to 12 months, right? And that's all she needed. And I was like, so when's a good time to raise a fund? And she asked me, like, well, David, like, do you want to raise a fund? Like, at some point in your life, in your, let's say, 90-year life, do you ever plan to raise a fund? And I'm like, well, yeah, probably I plan to raise a fund at some point, right? And she's like, well, if you plan to raise it, there is no way to time the market. whether you do it today or do it tomorrow, you should start building relationships now. Because market timing is always obvious in hindsight, but not obvious in foresight. There's this great analogy in terms of investing into startups, which is like the surfing analogy, where the market is the wave, the product is the surfboard, and the founder or the team is the surfer themselves. You need all three to be a great surfer, because if you don't have a wave but you have a great surfboard and you're a great surfer, like you can't really become a great surfer, right? So you need all three. You can't have two of the three. You can't have one of the three. And the other side of this analogy is it is better to be in the water before the wave hits than to be on shore when the wave does hit.
Like that.
And so that's why you want to be out there, right? So hypothetically, if I were to raise a fund today, first of all, as the saying goes, always be selling, always be fundraising. If you ever plan to raise a fund, or if you ever plan to fundraise for your startup, you should be out of market, and you should probably be having, I guess the rough litmus test is like, have like 2 to 3 new LP or new investor conversations per week. And there's the adage that goes like, hey, if you want money, ask for advice. And if you want advice, ask for money. Most of the time, you're probably not asking for money because you're not fundraising all the time, but you should definitely ask for advice. Like, hey, you know what? Like if you're a founder, like, hey, I've just hit this milestone. I want to hire my first executive. Everything, like things are trending. We are not fundraising. But if you were in my shoes where you've hit these metrics of 50% month over month growth and you want to hire your first sales executive because you built a great sales funnel, how do you do so? And I mean, let's be honest. Investors love giving advice in general, right? Although there's a great Hunter Walk adage, Hunter Walk at Homebrew, now like also running Screen Door and all that. He says, I'm paraphrasing here, it's actually in the book by Scott Belsky, Messy Middle. But the saying goes, if you sometimes listen to your investors' advice, you might fail. If you always listen to your investors' advice, you're guaranteed to fail. And so like take it with a grain of salt, but that said, investors love giving advice because it's very free. It's like it seems to go somewhere. And if you come back with like their advice actually went somewhere, it's a good dopamine hit for a lot of folks. And just on a very human standpoint, not even just like investor founder relationship kind of thing. If you're a fund manager, even if you're not fundraising now, always be building relationships with limited partners out there, because for them, and this is true for a lot of investors, especially long-term investors and value investors, it's all about investing in lines, not dots. And so it's much better for you to build that relationship over time, for them to see how you think over time, for them to see how you react to pitfalls as well as, you know, your best moments, for them to finally decide to like, I'm going to invest in your next fund. And some people might preemptively offer you a check, but always be fundraising.
Yeah, that's good. Let's switch to that or continue with that. So let's stay with that example. You've built a track record. You've been at a place like Alchemist. Maybe you've been at a venture fund or doing something for a while. You are, categorized an emerging manager, new manager. You want to get out there and do exactly that. You've been interviewing a lot of people who have raised funds. You've been interviewing a lot of LPs. What's the best way to find relevant LPs? Where does one start? And then how does one start to build a relationship with those LPs? What advice do you have?
I love this question. I have so many thoughts on this that it's going to go on for another 3 hours.
Go, let it flow.
First of all, limited partner, the world of limited partners is extremely opaque, because most limited partners, they probably invest in anywhere between 1 to 3 new deals per year, meaning they don't need to see thousands of funds. They don't have to. They're only picking one new fund to invest per year. And sometimes, especially in like bad economic times, they're more focused on re-ups. So re-upping into their existing managers than focusing on new managers, which was a big thing in 2023. And we're seeing a lot in 2024 as well. They're spending Q1, where we're recording right now, to decide how much of our existing portfolio do we want to re-up on, and does that leave space for new managers? And sometimes it doesn't, right? So because of all those reasons, they're not really starved for deal flow. And which is why if you do a LinkedIn search or Google search to search for limited partners, you will find almost no one who identifies as a limited partner. And the only people who identify as a limited partner happen to be individual LPs who are very proud of their early investments and fun ones. But even then, it's far and few in between, right? So if you're raising a $10 million fund, sure, go for individual. Any angel investor would be great for a $10 million fund, right? I think SEC says like you can have 249 accredited investors. That's an average check size of like 40K. And most angel checks are give or take 25 to 50. So that's like straight in the ballpark of the typical angel investor for raising a $10 million fund. If you're raising north of a $10 million fund, and this is not like, hopefully you have the disclaimer, this is not financial advice, not investment advice. Go talk to like legal, tax, all that professional. But you can only have 99 accredited investors. You have an upper limit cap of like 2,000 QPs, qualified purchasers, which are like $5 million.
Repeat that. Sorry to cut you off. What's the criteria for having 99 investors? Say that one sentence one more time, please.
North of a $10 million fund. So, which means if you're raising a $100 million fund and you can only have 99, I'm rounding to 100, you can the minimum check size or the average check size in which you can take from an investor or an accredited investor is $1 million, which is far north of what a lot of angel investors can do. Then that's in the target class of when you're targeting like, family offices, institutions, all that kind of stuff. I will also say most funds don't have like hundreds of LPs, right? Unless you're a fund one and you're just trying to target to get as many people in as possible because you're trying to get your proof of concept fund off the ground. Most larger funds have anywhere between like 20 to 40 LPs, right? Which means you are looking for larger LPs in general. So all that to say, your initial question was, how do you go out and find LPs? If you're looking for angel investors, literally anyone who identifies as an angel investor would be perfect for you. Also on the flip side, Nathan, you and I are both based in the Bay Area, and given the exorbitant rent and cost of living out here, pretty much anyone who owns a house out here in the Bay Area is an accredited investor. So if you can go to any house owner effectively, like, hey, you know what? Like, we would love for you to believe in us. And I know a lot of friends who are like raising smaller funds, where they talk to everyone, like talk to your lawyer, talk to your accountant, talk to your kind of like banker and all that kind of stuff. Talk to your dentist. Dentists make a lot of money, and convince them, pitch it to them, right? See if it resonates with them. If you're running a $10 million, like $15 million fund, any one of them would be a great LP for them to invest. And for them, for the smaller LPs out there, venture capital is not an asset class, it's an access class. So they're looking to learn, they're looking to find deal flow, they're possibly looking for co-investment opportunities. They're not necessarily geared towards financial return. Usually if you underwrite to a 3x net TVPI, multiple on invested capital, it's good enough for them. They're not raving about the 10x or onwards kind of thing. And even then, if you're raising a really large institutional fund, it probably doesn't make sense to like underwrite north of a 5x return unless you're just like really, really lucky. One, talk to everyone if you're raising from smaller LPs. For larger LPs, one of the very useful things that, at least for me when I started and built kind of a network in the LP landscape is, first of all, I started LPing because I was like, okay, if I want to raise a fund at one point in time, right? Like it's good to understand how my favorite fund managers think. And I went to a bunch of my fund managers and like, hey, I want to invest in funds because I'm paying my tuition effectively, right? And while I'm doing so, can you introduce me to kind of your favorite LP, like your LP that you have on speed dial that you absolutely adore? And they would like, if your relationship is good enough with them, they might intro, which I was lucky enough to have those relationships where they would intro. I would also say that if you don't have such a strong connection with certain individuals who can intro you to LPs, it's not worth asking because you're going to put them in a tough spot, and it's kind of awkward. The easiest way, I will say, to get to know LPs and have other people introduce you to LPs is to host events, intimate dinners, 6, 8, 10-person dinners. And you're like, hey, you know what? I'm hosting a dinner with a bunch of my favorite LPs. I'm inviting a couple. Do you have any friends who would also be interested in just getting to know other LPs in the Bay Area, right? And naturally, people are like, oh, like inviting someone to an event is so much of an easier ask than for them to say, hey, you know what? Would you be interested in getting a 30-minute coffee chat with someone you have no idea who it is, right? And so host events, host dinners. Intimate dinners are always great. Larger events are great in the sense of volume, but you might not build the same strength of a connection, the warmth of a connection that you have with a certain LP. That's another. And then finally, there are also other GPs, general partners for later stage funds that also invest into pre-seed seed funds. For them, it is a form of deal flow, because you'll invest in pre-seed, seed. They'll find out about these companies early on. By the time it gets to the Series A, they have an information advantage to be able to bet on the great companies in your portfolio. So a lot of like crossover fund GPs end up investing in fund ones and fund twos who are doing pre-seed and seed. I will pause there. As I mentioned, I can go on for 3 hours, but
let me pause you there because I have a couple questions about that. But those are all super interesting, good. In that last scenario, are you typically looking at the individuals at a more established later stage venture fund, or is the fund itself sometimes a later stage venture fund investing in, or both? I mean, what are you seeing happen there most often?
Do the fund so some crossover funds actually have their own fund of funds, small fund of funds, probably $50 million, $75 million fund of funds, writing $500K to $1 million check. So that for them is a dedicated practice where the team has a vested interest in early stage deal flow, right? There are firms like that, I guess, that publicly announced, like Village Global, that have like a $50 million fund of funds in order for like them to invest in early stage fund managers. For the most part, most funds don't have a dedicated practice of this, and this is largely you're talking to an individual partner who is like, hey, we've gotten along, we've co-invested in 3 deals together. 2 of those 3 deals that we co-invested together, I sent you, and you ended up going like, hey, this is a great deal. I'm now raising a fund. It could be a $5 million fund, $10 million fund, $20 million fund. I'm raising a fund and would love to continue our relationship where we're sending you our best deals out of our portfolio. And a lot of times it does transition rather well, and they'll write like a $250K check into kind of your fund.
Yeah, no, that's interesting. Okay, cool. This is all great. I guess let's carry on though. Any other cool, clever, creative tactics you've heard of or seen, emerging? I love the dinner idea. I think that's fun. Any other kind of just out there creative tactics you've seen people do to meet LPs or get on LPs' radar? Anything else?
I have seen some things. Before I mention some of it or share some examples, I learned this from Mark Suster, who runs Upfront Ventures. Actually, like we're off the cuff of like, Upfront Summit literally just happened this past week kind of thing. But Mark Suster has this line, which I think he gets from Zig Ziglar, which I will be honest, like was before my generation, but I've learned a lot more about Zig Ziglar because of Mark Suster. But he has this line where people don't care how much you know until they know how much you care. And this is especially true for the world of limited partners or just building relationships in general, right? Too often, people are quote unquote building these relationships and it's on a CRM tool. It's just like you only go to someone when you need something from them. It's very transactional in nature, right? And we're human beings. Like we want to be cared for. We want to feel like we're important individuals. This is true for limited partners. This is true for if you're a founder. This is true for investors you chat with as well. And so whatever you do, dinners or otherwise, you have to show that you deeply care about that individual as a person and not because of their checkbook and not because of their brand name. And there are various ways to do so. So I like hosting events myself. My events are a bit weird. I will say, like I do dinners and happy hours occasionally, but I also rarely do those. But I do things like I like interactive art galleries or an escape room where all the clues to escape out of the escape room are based on each LP's anecdotal stories, which means you do a lot of research in every single individual. And when they come, they're like, oh my God, this event was designed for me. And if I was not here, the event would not have been able to work out because it's an escape room and your clue is in it kind of thing, right?
Yeah, that's very clever.
An example.
I like it. Yeah.
Another way I've done when I was early on in my venture career, when I was like less so in the LPGP world, but more so like, oh, I want to break into venture per se. This is less true for LPs because you can't really find their addresses anywhere. But for most venture offices, they have their address somewhere. Most are based in Sand Hill Road or South Park and SF kind of thing. And what I did is I would write handwritten letters to each of these addresses, being like, hey, I would love to chat with you. And the reason for the handwritten notes is when, like, we have to look for where there's so right now we live in a world where a wealth of information leads to a poverty of attention. And to look for areas where there's not a wealth of information and inputs, virtually speaking, from social media to emails to all these kind of things. they're bombarded. Like these people that you want to get in front of are bombarded with messages. And so where are areas, and I apologize to all the GPs and LPs that I know that will soon get a lot of handwritten notes in their mail, but uh, like physical mail is still somewhere that is fairly like open ground, right? You get your tax docs in there, maybe you get your like, random coupons and all that, but everything is printed, right? Everything's in Arial font or Times New Roman font or something. And if you were to get a handwritten note, it stands out. Even with no other context to what that letter entails, it stands out. And all you need, the purpose of like a cold email is for that subject line to convert to them opening the message. The purpose of the cold email is for them to actually say, hey, I'm interested in having a conversation, right? The purpose of a handwritten like letter is for them to open the letter and then read it. And the purpose of that letter is hopefully to get you in a conversation with them. That's what I used to do. And then I would show up at their office, say, hey, you know what? I sent a letter in. I mentioned I was going to drop by the office a week from when I sent that, right? And I'm here now. Would this partner be interested in having that conversation? So that's what I did when I was like on the operating side as well, right? And sometimes it's like, oh yeah, like let me go check in with that partner and see if they're available to chat. Other times, they'd be like, oh, you know what, they're busy today, they're out of office today. Like, I'm so sorry, they're not here. And I'm like, oh, that's totally fine. I really wanted to come by and say hi. Is there a time that I can schedule time on their calendar for me to come by again? And the EA or the office manager like, hey, actually, let me check their calendar. Let me put you in their calendar effectively. And then I would actually then have an appointment and then show up and meet that person. So that was something I did back in like 2014, 2015, and 2016. May still work. We're also post-pandemic era, so take it with a grain of salt.
That's bold. I mean, that's very bold to show up at their office, but I love it. I've heard people getting jobs that way, of actually just showing up and be like, I'm here, give me a few minutes to chat. Like, that's interesting tactic. I like that. Very cool stuff. Let's stay on a tangential topic of building relationships. So great, you just got a meeting with this person, and obviously you don't hit them up for a check right away. Like, how do you kind of build and nurture relationships over a period of time? Maybe it's everything you just said, inviting them to dinners and stuff like that, but any other tactics for kind of nurturing building that line, over time?
So as an angel investor, I'm a consumer angel investor. So I invest in consumer products and all that. And the reason I bring that up is I spend a lot of time studying advertising, marketing, consumer practices in general. And there's an adage in the world of advertising where a person needs to see an ad 7 times before it actually resonates with them, which is why when you go to the Super Bowl, you see like the same ad like a million times. And you're like, okay, now I remember the Doritos commercial, or now I remember like whatever other commercial, right? And that part is like extremely important. Just being able to have even small amounts of time, even like 30 seconds, 10 seconds, right? Time that lives rent-free in the person you want to get in front of his mind. There are many ways to do that. Obviously, if you can constantly email them and say, hey, you know what, let's catch up. Realistically, most people are way too busy. And if everyone does it, they're just way too busy to hang out with everyone that comes in their inbox. One thing I really like doing is the first conversation. Sometimes you talk about business, sometimes you don't talk about business. Sometimes you talk about like, oh, you know what? They just had a kid and they're going through the struggles of being a first-time dad. And you're like, oh, they're looking for their next like vacation, or maybe they're looking for like nannies or something to take care of their child. They're looking for like, different kind of things. And you're like, oh, okay, let me make a mental note of that. And so every time I stumble across like baby products, baby food, it's like, hey, I stumbled across this article on like, best parenting tips. I'm like, not saying that I'm telling you how to do your job, but like you might find this useful, and you don't have to reply to me, right? Like, just see the email, see the message that I'm giving you. Don't reply to me. I just thought of you when I saw this. And you just send those things every so often. And then once in a while, when I'm actually hosting like a dinner or something that's designed for that audience. So if I'm hosting like a GP dinner, I'm not going to invite an LP, right? Like, it just that occasion has to be designated for them. So, but what happens if it like, hey, I'm doing an LP dinner, all family offices, and we're going to chat about portfolio allocation in 2024. And based on our last conversation, it seemed like that was something you were actively thinking about because 2023 was a interesting year for you, right? And would love to have you there. I'm also inviting X person, Y person, Z person, and I think you'll really get along with them because of these reasons. And that's why I think you should come. very intimate, 10-person max. That's it, right? People really care about people don't care how much you know until they know how much you care. The flip side of this is I also have a podcast, which I really recently started. One thing that I do with certain LPs, I think they're really cool people. I love building that relationship as well. But sometimes we talk about something in the podcast, and I'm like, oh, that reminds me of a part of a conversation that I had with another family office or a pension fund or whatnot. And that part of the conversation reminded me, and I'll just clip that and be like, hey, you know what? I just recorded a podcast, sending it over to you. Here's the full hour-long episode. You're not going to have time because of how busy you are to watch the full episode. So I thought this clip from that episode would most resonate with you because of our conversation in which we had, and tune into it. Something I actually learned, because I think Tim Ferriss once talked about this on a podcast or and whatnot. He's like, hey, when I first started writing the 4-Hour Work Week, I didn't ask people to read the full 4-Hour Work Week. I would bookmark and specific chapters or specific sections that I think would most resonate with the people I want to get that book in front of. And that's effectively what he did. And effectively, I do the same thing for the podcast. And I think that seems to do well for a lot of the kind of people that I've been very lucky to call friends.
I like it. All good stuff. Fun stuff too. Let's talk about types of LPs. I like your earlier approach of kind of talking to everyone, your dentist, your attorney, your founder friends who maybe had a successful exit. Those are all good, initial LP sources. What about, there's a lot of buzz about family offices as kind of the next wave, right, of LPs to look at. Any thoughts on that? And I guess, is there too much hype around family offices, or are they a pretty good second tier source of LPs? And any tips for reaching family offices, which are a little harder to reach than maybe individual folks? Thoughts?
Yeah, so there are a lot of family offices out there. And actually, once you're in the family office world, there's a surprising amount of family offices that are within your second degree network, like a surprising amount. There's a lot of early employees at tech companies or founders of tech companies that have gone through massive exits that have started their own family offices and started estate planning in the very early days. You have multi-generational kind of institutions that obviously have their family office as well. I think he's pretty public on LinkedIn, but Lego has a family office, Forbes has a family office, all these brands that we're familiar with that have gone through multiple generations have had their own estate planning and planning for multiple generations. In general, it's hard to find family offices. There are family office events that are out there. I would say to find family office out there in general, I would largely start talking to people who have probably done a fund 2 and fund 3, because then as a part of their fund size, they're probably chatting with a lot of smaller family offices who write anywhere between $500K or maybe $250K all the way up to $2 million. Those are still the best ways in. Family offices are notoriously closed off to cold emails because unlike institutions like fund of funds, pension funds, endowments, all that kind of stuff, they do not have a mandate to be investing every single year. It is very opportunistic for a large part, especially for family offices, right? And so hypothetically, they don't need to be investing in any venture funds for 3, 4, 5 years. In fact, if the next generation of individual who takes on the family office is not even interested in venture capital, they won't even invest in venture capital throughout their lifespan, right? And so having warm introductions goes a long way. For smaller family offices, a lot of it is around access class. So they look for co-investment opportunities. They like the idea of directly investing. They also invest in a lot of fund managers to learn from that fund manager. And so if you're raising from smaller family offices, the main thing you have to think about is you have to play more of the educator, right? There are a lot of large funds that are out there, the $500 million plus funds that just don't have the time or the resources or the interest to be educating their LP base. But if you happen to be going back to people don't care how much you know until they know how much you care. If you are willing to educate and be the professorial kind of fund manager in which they invest in, they will go to great lengths to support you. And they will, once you get one family office, they'll probably know a bunch of other family offices and they're going to intro you to them. And so it becomes this snowball effect after that. For the larger family offices, their checks are minimum check size are 10, 20, $50 million. And so you treat them in general, they're more institutional than family office, to be completely honest. They may have a dedicated practice to appreciate a generation's wealth. So then they probably appreciate like generation 5, 6, 7's wealth, or like 10, 11, 12's wealth kind of thing, right? And so they often have an outsourced or in-house CIO, chief investment officer. And for those looking through, and they usually hire these chief investment officers from banks, large like big four firms, but also endowments and like fund funds, private equity, hedge funds, and all that. And so if you usually look at, if you were to go out and look for it, right? Like people who come from that kind of career and then their current job, or they haven't updated their LinkedIn in a while, right? Or their current job is like, you know, the LinkedIn placeholder image of like, it's like two buildings, it's like grayscaled and all that kind of stuff. If they're at some kind of institution that has this random misnomer of a name, there's a good chance they're either deeply connected to family offices and or at a family office or running the family office themselves. Sometimes they'll call themselves chief investment officers. And if you do a quick LinkedIn search, you might find a couple CIOs out there as well. Those are possible ways to get in front of them.
Yeah, good. All right. I won't keep you too much longer, but just, a lot of good stuff for finding, sourcing, building relationships. I guess what is, for a first-time emerging venture fund, what do you think is most fundable? Let me give you a multiple choice with some leeway there. A, you've got a really specific, unique niche thesis. B, you've got experience working at a different venture fund. C, you've been an angel investor and you have a really interesting portfolio of deals you've done as an angel investor. Or D, you've got some reason why you've got proprietary sourcing for great startup deals. Or E, something else that I didn't list. Go.
Yeah. Some of these are not mutually exclusive. For example,
Sure.
like A and B, the niche vertical and the spin out are not necessarily mutually exclusive. Or like the angel investor who's doing like, has a proprietary source of deals, like runs a community per se, right, is also not mutually exclusive. So in that world of most fundable, I will timestamp this to March 1st of this year, so things may change in the future. The most fundable right now are naturally spinouts. The spinouts doing very niche verticals and have concentrated portfolios. So probably have portfolio sizes of less than 20 companies. I'll give the reason why. We're in a down market right now. I think it's, no one's going to disagree. It's like, hey, we're in a good market. Like, I think job market sucks, fundraising market sucks, IPO market sucks. Like in general, just interest rates are higher and all that, right? And so in this world, people LPs are relying on pattern recognition. Whether that's good or bad, that's a whole separate discussion altogether. But they're relying on pattern recognition, and the easiest pattern to be able to recognize are brands and logos. And so if you are a spin out, it is much easier to tell your story and at least to get face time with an individual. Because if you go like, hey, I'm a spin out, I came from Sequoia, Benchmark, Greylock, wherever it is, right? That word in and of itself will have someone open an email and have a conversation with you. If you don't have that spin out logo, it's just so much harder. Even if you were early operator at Stripe, Google, Stitch Fix, I don't know, wherever it is, right? Like, it is much easier to say like, hey, I have a referenceable VC brand that I used to be investing out of, and that's why I should raise my fund. And I'm raising my fund off the backs of I did these deals at this previous fund, and I have a referenceable, portable track record. And so those are really easy. Niche and concentrated portfolio is really interesting for LPs. So first of all, if you're raising a sub $25 million fund, sub $15 million fund, you have a lot of individual LPs, a lot of angel investors, a lot of dentists, tech employees, founders, GPs from other funds. In reality, a lot of that is just like, Nathan, I like you as an individual, and people won't be happy if I say that, but people like, I like Nathan as an individual, and that's why I'm going to invest in him, because I think one, he has something very interesting. He has a world vision that I think is very interesting, and two, I think he is a person who will fulfill his promises, and that is why I will invest in Nathan. Because in the fund one and fund two, it's so early on that and I'll give credit where this is due, but I learned this from Samir Kaji, who runs Allocate, which is like fund one, you're selling a promise. Fund two, you're selling a strategy. Fund three, you're selling the returns on fund one, or fund four, also selling the returns on fund one and fund two, right? And when you're selling a promise, there's really nothing to go on. When you're selling a strategy, you're selling here's what I learned from fund one, here's what I learned from, like, here's the mistakes I made from fund one, and this is why I'm not going to do certain things, this is why I'm going to double down on certain things. So in that world, that's like, there's no number logo they can possibly track. So spinouts are the easiest. Niche is also very interesting, is because after you get past the individual LPs, a lot of LPs think a lot about portfolio allocation, which is, I want to have 10% or 20% of my underlying asset class into consumer. I want 25% into enterprise B2B. I want 25% to impact, and I want the last like remaining percentage to be in kind of like deep tech, or like things that are like truly revolutionary in terms of a technological standpoint. And they start bucketing things together. And why that matters is, if you are a generalist, you don't fit in a bucket. So there's no clear reason as to why an LP would be like, oh, I would invest in you because you are seeing a lot of consumer, enterprise, or whatever deals, right? And the reason generalists are, for most LPs, not all LPs, for most LPs dangerous, is because you might end up having the same overlapping underlying asset as another fund manager they've invested in. If you're a generalist and another fund manager they're invested in is like enterprise, and you just happen to have company A, B, and C, which are overlapping in your existing portfolios, they may have overexposure to that risk for those specific companies. And if their total like underlying portfolio is like 300 startups, right? And out of those 300 startups, 30 of them are overlapping, that's worrisome for an LP, which is why they like niche verticals. And finally, concentrated portfolios. Diversified portfolios have, what I think there's studies on this, so like 90% chance of getting a 2x and all that. And it's like, if you have a portfolio of 40, 50, whatever companies, you're almost guaranteed not to lose money effectively, right? But you have a very, 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 very small chance of getting north of a 3x. At the same time, if you're going to only do a 2x return, you might as well be an LP investing in the public markets, the like real estate and all that, and that public probably might appreciate as fast, if not faster, over 10 years, because it's also illiquid if you're investing in venture capital, right? So diversified portfolios, a harder sell to LPs unless they have a co-investment and deal flow strategy. If they're looking for co-investments and deal flow and they do direct investments, then it matters a lot more. But most LPs are passive capital. And so because of that, they like the concentrated portfolios, because there's less likelihood that you are going to overlap with kind of like another portfolio. And if you have outsized ownership on these companies, you've a larger possibility of outsized returns. And that can generally be a great fund-to-fund strategy for a 5x, give or take, like fund-to-funds.
So much good stuff there. What have we not covered? Like, what are the other magic secret ingredients or catchphrases, keywords that really get the attention of LPs? I mean, you've covered a lot, right? Having a track record, having a repeatable track record, possibly being able to feed them deal flow because maybe they're in the same category, but later stage. Other kind of special ingredients we can put into our stew to really make it the best, most fundable first time fund ever. What have we forgot? What have we missed?
So as we're in the fourth leg of the relay race over here, I will also like remind probably our audience over here that I'm a work in progress. Like, I clearly don't have enough whiskers on my beard to be like, I know everything. I don't have enough salt and pepper in my hair to be like I know all of this. A lot of it is anecdotal, and a lot of it is I spend a lot of time with people who are way smarter than I am, which is also why I do the podcast and all that. In terms of things we haven't covered, there's a lot more niche or nuanced things that we haven't covered. I think in terms of if you were only to take like one takeaway from this conversation, I think I'd go back to the Zig Ziglar quote of like, people don't care how much you know until they know how much you care, and everything you do should elicit that line, that how much you care. There are many ways to do it. Like, for example, small things. When you're jumping in an LP conversation for the first time, like, I almost would say do not pitch. Like, don't pitch at all, right? Don't talk about your fund. No one cares about your fund and all that kind of stuff, right? In the first meeting which you have, let's say you have a 30-minute meeting, 20 to 25 minutes should literally just be asking questions and understanding what the LP is investing in. Because there's a good possibility this hypothetically technically is an LP, but they're not allocating to deep tech, and you just happen to be a deep tech fund. And then sometimes you don't find that out until you're 20 minutes into your pitch and like, holy frick, I wish I found out sooner, then I wouldn't have to pitch all this to you kind of thing, right? So understanding what kind of things the LPs are interested in, are investing in, is really, really important before you even get to their pitch. In fact, I would almost save the pitch as a conversation number 2. Conversation number 1 should always just be a teaser. This is what I'm doing. This is the fund size. This is what I'm excited about. If this is of interest to you, and based on our conversation, it sounds like it's of interest to you, let's take it to a conversation 2. Or sometimes you should self-select yourselves outside of it, right? If an LP goes like, hey, I'm interested in concentrated portfolios, building on niche verticals, and you're a generalist fund, don't change your pitch for that LP. Just be like, hey, you know what? I'm a generalist fund. I'm not even going to pitch to you. We're building 2 different worlds. There might be other folks based on your mandate that I could intro you, and that's a long-term relationship there. It's like, hey, they may not invest you and recommend someone else who is a better fit for them. There are other times, that's also another red flag, which is, let's say I get approached by a $10 million fund, or maybe like let's just say I had like a lot, like hypothetically, let's say my minimum check size was like $5 million or so, right? And my capped percentage, I don't want to have more than 10% in the fund, which means the minimum fund I would invest in would be a $50 million fund. And if a $10 million fund manager comes to me and says, hey, you're doing a $10 million fund, then finds out I do a $5 million minimum check size, and then they go like, actually, we can actually do a $50 million fund. No, don't change your strategy because of an LP's check. Your strategy should be fundamentally be based on what you are extraordinarily dispositioned to be able to win on, right? And if your strategy is first check-in, pre-seed seed, no ownership target, and no reserve strategy, don't change that just because of an LP can write a larger check size. I think that's one of the biggest follies that I've seen, because that means, one, and putting it very simply, LPs pay GPs for their opinion. That's why we pay management fees. That's why we give you money. We pay for your opinions. If you're able to switch your opinion purely based on check size, that means you don't have an opinion, right? And we might as well invest in the next person over. And even if we disagree with that opinion, that they at least have an opinion of the world that they'll stick with. So going back to what I mentioned earlier, in Fund 1s and Fund 2s, it is not only one, you have a great world vision, and then 2, we deeply believe that you have the ability to follow through on your promises. And if you're able to switch within meeting number 1 on a promise you gave to yourself just because someone else had a different set of tools available, that's very dangerous.
Yeah, this is really good. 2 more questions. I'll let you go eat lunch or whatever is next on your plate. Because that's an interesting topic. Any other kind of common mistakes, pitfalls, red flags you see first time or emerging managers make? Like, what are people doing wrong when they're yeah.
There's a lot. Like I'm gonna be honest, on my personal end, I have it on a Notion page and all that. Like, I spend a lot of time thinking about red flags because, first of all, personally, I don't believe in checklists unless it's a checklist on red flags. Meaning, I don't invest into founders and or fund managers because they check off all my boxes or they check off 70% of my boxes. I don't believe in that, because I do deeply believe the next founder I invest in, the next fund manager I invest in, will look like nothing that I've seen before. And as a function of looking like nothing I've seen before, it is an outlier. And I cannot predict outliers via a checklist. So I don't do really like checklists of like, this is why I should invest in a fund manager. But I do have checklists on red flags. And I think at this point I have like, I kid you not, on my Notion page, I have like a checklist, like 50 red flags of like things that I like look at and I can kind of run through all of them. But I generally prioritize red flags in general. So another one that I might not have mentioned is like logo shopping. And portability of track record, which I think is in the same vein here. If you have a track record previously, either as a syndicate lead, angel investor, spin out, doesn't matter what it is, that's great. And I see too often that a lot of fund managers go like, here, my track record was a 5x TVPI with a 30% IRR. And this is across 30 investments I've made over the past like X amount of years, right? Great. And then I kind of look at like, what is the thesis of the fund? If the thesis of the fund is I'm investing in mobility at the pre-seed stage, writing 500K checks, or maybe not 500K, maybe like 100K checks because it's a fund one or something, no reserve strategy, I'm then going to look back at your track record and then look at like what of those previous 30 investments actually were on thesis investments. And maybe out of the 30 investments you made, only 5 of them are on thesis. And that's okay. That's okay. 5 investments that are on thesis is okay. Ideally more realistically, but if it's okay, good. Then I look at the intellectual honesty of the fund manager. And if people can approach me with intellectual honesty before I even have to go through that analysis, that would help so much. I'm like, hey, you know what? I've done 30 investments, but I'm raising a fund on mobility pre-seed 100K checks. I realize out of my 30 investments, only 5 of them fit. And here's my TVPI IRR for those 5 investments. And I also realize that's a small sample size, but I deeply believe that this is going to be a thing, right? I love that a lot more than just hiding things under the hood and bundling your track record together with previous things. So that's one. The flip side of this is it gets more egregious when you say you're an early stage pre-seed investor. And I've used this example before, but like, let's say you're a space tech fund, pre-seed seed fund investing in space tech. And on your pitch deck, you're like, hey, I was an early investor in SpaceX. And you're like, well, of course, SpaceX is a brilliant logo to have when you're a space tech investor. And then we actually do our diligence. And then we find out you were a part of an SPV that invested in the Series D of the SpaceX deal. And you weren't even the syndicate lead for this, like, a Series D deal. So realistically, if we called up Elon Musk or any of the executives, they would have no idea who the hell you are. That's not a good logo to have on your pitch deck. In my opinion, right? Might be contrarian in nature. I would much rather have, I invested in these smaller space tech companies that were all pre-seed seed based on my thesis. And these are why I think they're well dispositioned in the future. I'd much rather have that than you saying like, hey, you were early investor in space tech and has nothing to do with your thesis.
Yeah, that's good. That's good. That's interesting. I know I felt like we saw that a lot when AngelList was kind of at its peak or heyday, and a lot of people were making, angel investments into later stage rounds, and then they put Facebook on their, list of investments. Of course, they invested at, some super late stage, or even, right after the IPO or something. Like, you didn't source that deal. You weren't hanging out with Mark Zuckerberg at the pool parties in Palo Alto and, slipped him a 25K check.
Honestly, totally, right? Like that's what we're looking for, right? Like when we're underwriting fund managers, we're writing, and I'll give credit to Samir, who taught me this at Allocate, as well as Ben Choi at Next Legacy, that like LPs typically look at 3 different wavelengths of an investor, right? Sourcing, picking, winning. And you need to be strong in at least 2 of those 3, not just 1 of those 3. You don't have to be good at all 3. And if you realistically, for most fund managers, you're not going to be good at all 3. So don't kid yourself that you're good at all 3. Because if you are, then it's another set of alarm bells of like, oh, you think you're good at everything. It's like, when you go to a job interview and you go like, what are your weaknesses? And you're like, I have no weaknesses. I am perfect. And it's like, well, no one's perfect, right? But truly understanding where your really great strengths are, like an A++ strengths, and also understand where your like B-, maybe C+, like quote unquote weaknesses are really important. So you need to be good in at least like 2 of those 3 things. And if you say you're really good at sourcing, for example, right? Then it's like, well, were you hanging out at the right pool parties? Were you hanging out at the right college reunion? I'm making these up, right? Are we hanging out at the right parties in order to fully understand and fully encapsulate like good companies? The picking, which is like once you see a good company, like, can you recognize it's a great company? And that's actually really hard. Like it's harder than you think it is at the earliest stages, right? And the last of which, and also I will also say, like for picking, usually picking doesn't become obvious until you're 7, 8 years into your track record. And so if you're year 1, year 2, like it's so hard to say like you're good at picking or not. And the last is winning. Like, do the best founders pick you? If Mark Zuckerberg were to start another company, or Max Levchin or Elon Musk or whoever it is, right, or start another company, will they go like, Nathan, I'm going to you because like you have something that I deeply want, even if I'm starting my next company. And those are just like a couple examples. There are other like, exited founders, serial executives that if they started a new company, would they pick you?
Yeah, that's good. Okay, my very last question. We've gone a bit over time, but this is really great stuff.
Hopefully helpful
Is there-
to kind of your audience.
I think so. I really think so. I mean, our audience is expanded from, as you know, from startup founders to a lot of emerging manager VCs using our new funding stack. So this is great content for them. And so my very last question is, are there any other tips, funding hacks, best practices, nuggets you've learned from your podcast? Here's where you can plug your podcast, but any other nuggets that we haven't covered that you want to just drop in? I love how you've actually been pulling things from Samir, Ben Choi, and dropping them in. That's great. Anything else? Or if we've covered it all, that's okay too.
I think we covered the vast majority of it. I will say, like, some of the tidbits that I mentioned about Samir and Ben and all that, like, they happen to share with me on our podcast recording. I will also say, in the world of podcasts, and not even just podcasts, in the world of content, one of the best ways to build friendships over time is by producing content with each other, and then, like, a rising tide raises all boats kind of thing. And for me, my North Star of the podcast is not number of viewers or listeners or downloads, although it is nice. Don't get me wrong. Like, it is nice to see some of these numbers go up. But the real reason behind, like, why I do the podcast is I get to ask some really interesting questions to people that I've known for a while, or LPs that I just like am fascinated about. And through the podcast medium, you have the excuse to do homework on individuals that you normally don't have the excuse to. So you really get to understand a person's life through and through. And at least for my goal for every single episode is that my goal is to understand my guest better than they know themselves at that point in time, which I know is a very tall ask, but it gives me the excuse to kind of like go down the rabbit hole of like Ben's life or like, Samir's life. And, some of these episodes might come out a little bit more, like, for example, I found out that Ben proposed to his now wife on a 20-foot billboard in Orchard Road in Singapore, right? And you also find out these other things where he's like, he was a founder of Coffee Table, and he first, like, how did he first build like a brochure magazine kind of virtual version of that? And he's an LP now, right? But he's gone through all walks of life, and I deeply, deeply love Ben.
Yeah, really interesting stuff. Okay, let's give a plug to your stuff. You've got your Cup of Joe, which is CUPOFZHOU.com. That's your blog, correct?
Yeah.
Wonderful. Yep. Go ahead.
Yeah. So like, I'll say, like, I don't know if I count myself as a content creator, because sometimes I actively disincentivize people to like tune into my content, which I might be shooting myself in the foot. But for Cup of Joe, which is my blog, Cup of my last name, ZHOU, I write about literally whatever. Like, you'll see I write about social experiments and food, and obviously VC and LP topics, which as of late I've been thinking a lot more about it. So a lot of the blog posts have been a lot more about VC and LP content. But it really is a personal blog. Like, I write whatever I want to write on it. I do write on a weekly cadence. So in case you're interested in tuning to my random shenanigans, I do that. I also have a podcast that we've mentioned a couple of times, that Nathan, thank you so much for being like a supporter of that in my journey, because I started that like October, November of last year, where all I do is my goal is to help the emerging LP think like an established LP. So to help the first time LP, whether you're an individual, smaller family office, or a pension fund allocating to venture for the first time, to understand how institutional LPs think who have allocated to venture for a very long time, and the best practices, tactics, frameworks from that side of things. I will say I have a growing audience of GPs who tune into that podcast as well, because they're sometimes interested in listening to how LPs think.
Yeah, no, it's very clever. I mean, it's a very niche audience, but or topic, very niche audience, or sorry, very niche topic, but actually quite a broad audience, because I feel like everyone is becoming a VC these days, right? Everyone wants to be a VC.
That's
so
true. It's the hot job. Everyone wants to be a venture capitalist, want to be a capital allocator. So if you're interested, the name of the pod is called Super Clusters. There's also a fun story behind why it's called Super Clusters, but I'll save that for another time.
Hint, because what does that mean? Give us at least a tiny teaser on it. So, clues, like your escape room. Make it a virtual escape room. Give us a hint.
Okay. I think I've mentioned this at least once or twice publicly. So if you want to, like, there's the answer guide exists somewhere out there.
Okay.
Actually, probably in the form of one of my blog posts. But superclusters comes from an astrophysical concept. So if you're into astronomy and astrophysics, it comes from that. And if anyone is able to debunk this independently of finding the answer out there somewhere, let me know.
Okay, interesting. All right, that's enough clue. Do you want to share any other URLs, your Twitter handle, your contact information if you want to? Totally don't have to. Anything else you want to share here before we conclude?
No, I think like you can probably find me on all the socials. I'm also a consumer angel investor, so I'm like literally on all the socials. Some of them might have more esoteric names, but I guarantee on all the socials. So you can always find me there. If I love cold DMs and cold emails in general. So if, like, I love chatting with people who have world perspectives that I don't. And then lastly, like, for superclusters, I don't know when this is going to go out, but as at the time of this recording, at least, season 2 has yet to come out, and season 2 is scheduled to come out March 11th. So tune in for that. I will say I've gotten better as a interviewer, and I am embarrassed by season 1's interview style, like at least personally. My guests shared such incredible thoughts, and I will say for my first 9 or 10 guests, they carried most of the conversation. But I think season 2 I've become better, and we have a great set of family offices, fund to funds, and different folks from around the world.
I like it. At least drop your Twitter, because I'm just searching for David Zhou.
Oh yeah, so Twitter is also
you.
Cup of Joe, but instead of OF in the middle, it's A. So CUPAZHOU.
All right, David, that's enough. I've made you speak long enough. This is great stuff. Thanks so much. I like what you're doing. Keep it up, and maybe we'll get you on a year from now or 6 months from now and see what new wisdom nuggets you've picked up. Because I'm lazy, right? I like this. You go out and do a bunch of interviews with LPs, and I'll come and just extract from your brain the best little nuggets. So.
I honestly really enjoy the process of discovery. I honestly like learn a lot from people who are smarter than me, and I borrow chunks of wisdom from other folks as well. But the process of like discovery and finding data and like parsing data in interesting ways that the world has yet to parse is like fascinating to me. So happy to be on. Thanks for having me on today. This has been so fun. I'm often on the other side of the table. Nowadays, I'm more on the other side of the table. So it's fun being on the other side of the mic.
A hot seat. All right. Thank you, sir. Have a good weekend, and keep up the good work. Over and out.
I appreciate you. Thank you.